The US may have just made a move that could cost it billions. With Trump's latest 25% tariff on Canadian imports, tensions are rising. Is this decision pushing Canada closer to China? Meanwhile, China is reducing its imports of US oil, shifting toward Russia and Iran instead. Could Canada's response trigger a major economic shift? And what does this mean for the US economy? At the start of 2025, the White House sent shockwaves through Canada with a major announcement. President Donald Trump imposed a hefty 25% tariff on Canadian imports. The reaction in Canada was immediate and intense. Government officials, business leaders, and citizens alike found themselves asking the same question: how should Canada respond? Some advocated for strong retaliation, arguing that Canada shouldn't just sit back while its biggest trading partner tightened restrictions. Others warned that an aggressive response could hurt Canadian businesses and workers. But one thing was clear: Canada wasn't going to take this lightly. Prime Minister Justin Trudeau declared that all options were on the table, emphasizing a united front against the new tariff. Meanwhile, Ontario Premier Doug Ford took an even tougher stance, suggesting bans on American liquor imports and possible cuts to energy exports to states like Michigan and New York. The economic relationship between the US and Canada is deeply intertwined. Any disruption can create widespread consequences. A significant portion of US refineries, especially those in the Midwest and Rocky Mountains, depend on Canada's heavy crude oil. If Canada were to restrict oil exports, gas prices in the US could spike, creating an economic shockwave. At the same time, Canadian oil-rich provinces would also face financial repercussions, making this a delicate balancing act. But while North America deals with this energy dispute, another major shift is happening on the global stage. China is making big moves in the oil market. China's relationship with US crude has been shifting dramatically. American oil exports to China have plummeted, dropping from 115.6 million barrels last year to just 81.9 million barrels. The reasons? A slowing Chinese economy, a push for renewable energy, and a growing preference for oil from Russia and Iran. In response to US tariffs, China hit back with penalties of its own. Starting February 10, 2025, US crude oil faces a 10% tariff, while liquefied natural gas, LNG, and coal are slapped with a 15% tariff. This is a major turning point in global energy politics. China, once the second largest buyer of US oil, has now fallen to 6th place. And it's not just cutting back, it's strategically shifting its imports toward nations that offer better deals and fewer political strains. Instead of relying on Western suppliers, China is deepening ties with Russia, Iran, and Venezuela. According to energy tracking firms, China's imports from these sanctioned nations are climbing. For instance, shipments from Iran have increased by 2%. While this might sound small, given China's daily crude imports exceed 10 million barrels, that's a significant shift in global oil flow. China is taking full advantage of discounted Russian oil, especially since Western sanctions have forced Moscow to offer steep price cuts. Similarly, Iranian oil, despite US sanctions, continues to flow into China through indirect shipping routes. Iranian tankers often switch off their tracking systems, transfer crude to other vessels at sea, and reappear under different national identities, effectively disguising the true origin of the oil. Venezuela, also under US sanctions, uses similar strategies to get its crude into China through third-party traders and opaque financial channels. China's evolving energy strategy is not just about getting cheaper oil, it's also about securing long-term supply and reducing reliance on Western markets. By diversifying its suppliers, China ensures that no single country has too much leverage over its energy needs. Additionally, buying oil at a discount allows Chinese refiners to boost profit margins, giving them the ability to either lower domestic fuel prices or flood the market with cheaper refined products, further strengthening China's economic influence in Asia. Tracking these secretive oil trades isn't easy, but analysts use satellite imagery, ship tracking data, and port records to uncover the real picture. Some oil tankers mysteriously disappear from radar, only to reappear at different ports with altered shipment records. Hotspots like Malaysia and Oman have become critical points for these covert transactions, allowing Iranian and Venezuelan crude to be relabeled before reaching China. China's pivot to cheaper oil sources is reshaping global energy markets. Traditional suppliers like Saudi Arabia, Angola, and Brazil are now facing increasing competition, forcing them to adjust pricing strategies to remain competitive. Meanwhile, Russia is capitalizing on China's growing appetite, making Beijing one of its most crucial energy partners. In 2023, trade between China and Russia surged past $240 billion, with oil and gas making up a massive chunk of that figure. China and Russia have also expanded their natural gas trade, completing the Power of Siberia pipeline in 2024, and discussions are already underway for a second pipeline that would further integrate the two economies. By securing long-term energy ties with Russia, China is reducing its reliance on Western-controlled markets and insulating itself from potential future sanctions. China's energy maneuvers extend beyond just Russia and Iran. Its trade with the UAE has also been expanding rapidly, with non-oil goods making up a significant portion of the $95 billion in trade between the two nations. However, energy remains at the core of their relationship. China's state-owned energy companies have signed major deals with the Abu Dhabi National Oil Company, ADNOC, to explore new reserves and boost production. This move further solidifies China's position in the global energy landscape. But it's not just about oil. China and the UAE are also investing heavily in renewable energy. China, already a leader in solar panel production, is helping the UAE scale up its clean energy initiatives, ensuring that their partnership remains strong for the long haul. China's shift away from American oil could have significant consequences for the U.S. energy sector. Lower demand from China means downward pressure on crude prices, potentially shrinking profit margins for U.S. oil producers. This could discourage new investments, slow down job growth, and even impact long-term economic projections for the industry. Additionally, a shrinking oil trade between the two superpowers could widen the U.S. trade deficit, putting further strain on an already tense economic relationship. By reducing its dependence on U.S. energy and strengthening ties with Russia, Iran, and other non-Western nations, China is making a calculated move to reshape global trade dynamics. And as it continues to build economic alliances outside of Western influence, the U.S. may find its ability to exert leverage through sanctions and trade policies increasingly limited. China's energy strategy is more than just a response to tariffs. It's a long-term play to secure cheaper resources, strengthen its global influence, and reduce dependency on Western markets. Meanwhile, Canada finds itself at a crossroads, caught between a trade war with the U.S. and new opportunities in global energy markets. Did Trump's tariff move backfire? How will the U.S. respond to this shifting energy landscape? Did Trump make a mistake, or was this a necessary move? China's shift to Canadian oil is a significant geopolitical and economic event, with consequences that go beyond just oil. They reflect broader global power dynamics. Did Trump's tariffs backfire? That's still up for debate. Supporters argue that they protected U.S. industries from unfair Chinese competition, while critics believe his aggressive tariffs pushed China to seek alternative partners like Canada. Let us know your thoughts in the comments, and don't forget to like and subscribe for more global insights. Thanks for watching.